I put an early retirement plan into the most popular retirement planning software for DIYers, and the results seemed too good to be true, and as it turns out, it was. Hi everyone, Chris here with another episode of Authentic Early Retirement, where you track my journey to hopefully retiring early, somewhere in my early 50s, mid 50s maybe. In today's episode, I thought it was going to be a little earlier than I thought it was, but turns out that the plan needed a little bit of work, and we're going to go into that now. I have been trying out some different scenarios in Boldin to see the chance of success in the Monte Carlo simulations. Boldin is the most popular DIY planning retirement software, and for good reason. I'm not here to knock it, but just to point out some limitations. No tool is going to do everything perfectly for you. One of these simulations was to see the absolute earliest age my wife and I could retire, with a good chance of success in the 80% range. I was making changes to things like monthly expenses, health care, what if scenarios with and without part-time income, just generally messing around with the plan. And I ended up getting a surprisingly favorable result at age 52, with both my wife and I retiring and even not even needing part-time income, and with a fairly decent monthly withdrawal amount. Not really the full amount we want to fully enjoy ourselves in retirement, but enough to be very tempting and to make me do a double take. I began to do some investigation to figure out where I may have messed up, because this seemed way too good to be true. And there, right in the middle of age 56, our after-tax savings run out and it starts taking withdrawals from my 401k. Well, that's a problem. Why? Well, let's look into the possibilities that are allowed by the IRS to avoid being penalized 10% on top of any taxes owed at our ordinary income tax rate. First, we can begin taking withdrawals at the age of 59 and a half, because that's penalty free, but that's not going to work in this case because we're trying to go earlier than that. Second, you can do Rule of 55, which is penalty free withdrawals from 401k of your current employer, but it's only in or after the year you turn 55. Other employer 401ks do not qualify. That's also not going to work here because in this scenario, we're saying 52. The next option, Rule 72T, substantially equal periodic payments, or SEP. Specific IRS approved calculations for the amount withdrawn, equal withdrawals for longer of 5 years or age 59 and a half. This is inflexible as the amount cannot change, and if you make a mistake along the way, the 10% penalty is retroactive back to the year you began taking the equal payments. This option is one I would personally like to avoid unless it's an emergency. Then you have to get creative. You can do Roth conversion ladders. A Roth conversion is the process of moving money from a traditional IRA or similar pre-tax retirement account like a 401k into a Roth IRA. You pay income taxes on the converted amount in the year that you take the withdrawal, in the year that you do the transfer, but then the funds grow tax-free, and qualified withdrawals in retirement are completely tax-free with no required minimum distributions during your lifetime. A 5-year holding period does apply to avoid penalties on earnings if you're under the age of 59 and a half. To build a Roth conversion ladder, you would plan ahead and start converting from your pre-tax accounts to your Roth IRA 5 years before the first year you would need that money, repeating these conversions each year for as long as you need. You have to be able to make it 5 years before you can access the first rung in the ladder by living off of after-tax savings or maybe some other income. But be careful, as too much income makes a Roth conversion undesirable. Part of what makes a Roth conversion advantageous is to do them in years that you would pay a lower tax rate on the withdrawals than you normally would. Doing this while living off of after-tax savings is a great sweet spot to pay potentially very low tax. And you needed to convert enough to bridge the rest of the gap until age 59 and a half. Oh, and you would have needed to pay the tax using your coveted after-tax savings without using so much that you can't live off the remaining during this bridge time. We'll revisit an example of this later in the video because this is very tricky. After these options, there is only one other option, and that's the nuclear option. You just decide to take the 10% penalty for all withdrawals needed prior to age 59 and a half. In this situation, that would be 3 years. If you took $100,000 out and were married filing jointly, you would owe $7,640 in tax. After your standard deduction and progressive tax rates from 10% up until some of the 12%, that's 7.6% of the withdrawal going to tax. Then add another $10,000 on top of that, and you have paid more in penalties than tax. As it turns out, this is exactly what Boldin is recommending. To Boldin, this is purely a math problem of taking money out of accounts in whatever withdrawal order you have configured. The traditional default order in Boldin is for taxable accounts to go first. Withdrawals come from your taxable accounts first, then tax deferred. It is not worried about figuring out if you're retired from your job in or after the year you turn 55. I know it's not using Rule 72T because the suggested withdrawals are not equal, and they also seem a little high for what would be approved by the IRS with their calculations. And it is not computing some complex, detailed Roth conversion ladder. While Boldin has a Roth Explorer that's very useful, this early retirement ladder strategy is not part of that, at least yet. I had been mulling over this problem for a few weeks, but it just so happens that Boldin just made the AI assistant available in beta mode for paid members in the Planner Plus. This issue was the first thing I could not wait to ask the AI planner assistant to hopefully see how Boldin comes to these conclusions on withdrawals prior to 59 and a half. You can see the assistant reviews my plan, reruns the forecast, and checks their internal docs. And then it confirms that it does not apply a 10% penalty for 401k withdrawals prior to 59 and a half, and it assumes that you have figured out the best way to access this money yourself. And then it basically contradicts itself a bit by saying I could have used Rule 55, even though it clearly says my retirement age is 52. And then it suggests 72T, which is not compatible with the uneven and high withdrawal amounts the plan suggests. Okay, and here it's confirming that the planner is strictly math first. You can set a custom withdrawal order of your accounts if you want, but it says it's up to you to ensure your real-world execution avoids the 10% penalty or incurs the penalty. Next, it correctly asks if you've considered 72T, which, as I've said before, I don't like that because of the lock-in and the inflexibility for a long period of time, or a Roth conversion ladder to bridge the gap until you reach 59 and a half. So I tell it I don't like the 72T and elaborate more on the Roth conversion ladder recommendations. It responds by telling me to use the Roth Explorer to help fill up the 12% and 22% tax brackets. But the thing is, I've played around with the Roth Explorer, and it's going to look at the full retirement lifetime and not focus on just the bridge years, which is totally understandable in a lot of cases. Okay, now it's going to bring up the fact that I'll need to pay taxes on these conversions from my after-tax savings, and it asks, do I feel like there is enough to do this and cover living expenses during the bridge time from after-tax savings? I kept going back and forth a bit, and it modified my plan during our chat to add a 10% penalty buffer starting at age 52 to see what this would look like if I took the penalty. This is really cool that it'll do this in real time, so you can kind of have a back and forth with the AI planner assistant, and it will modify your plan and test out these scenarios. But right now, this just isn't nuanced enough for me. I feel like there's a more surgical way to approach this. I will say that I did, not shown here, but I did go back and forth with the chat some more and try to get it to customize adding the 10% only in certain years. But again, it's not nuanced enough. I feel like this is another opportunity where I need a more nuanced, purpose-built kind of one-off tool. So now, whether this plan has a chance to succeed or not is kind of up in the air, and it's going to require a little more investigation, a little more nuance. Maybe it's time now to talk to a financial advisor, somebody who's seen this and done this a bunch of times, or maybe if you're somebody like me who's an IT nerd, you're going to go a little crazy and build a tool that's going to dig into this yourself. So that's what I want to do now. I actually, thanks to AI, it's whether to be in awe of it or be scared of it right now is kind of the question. And as an IT guy, I'm kind of caught in the middle. All I can tell you is that I started building a tool a few days ago, and I did in a couple of hours in a night what it would normally take probably a team of a few developers a couple of weeks, just a few years ago. So it's a little bit scary, but a little bit awesome too. So I've been tweaking it a little more, but so it doesn't know everything. It still needs a human to tell it everything it got wrong and to go back and redo it. But was really able to put something together really quickly that I think I can share with you all that will illustrate this scenario of, well, we've got a plan that's got some gaps in it, but maybe we can do a Roth conversion ladder that can make it, bridge that gap or at least get close, see what it looks like to even accept the penalty. But let's take a look. Okay, bear with me. There's a lot going on here. But this is what I built using AI Code Assistant. So what this does is it allows you to put some numbers in. You can put in total pre-tax account balance. You can put in the total of your taxable accounts, your after-tax savings like your brokerage, your savings, and you can put in how much you plan to spend, in your early retirement years. In this case, it's in those bridge years. You can put in a birth date so that it knows your age, so that it can calculate what your retirement age is going to be. You can put in the month and the year you want to retire. So what I did here is I set this up with just some fictional numbers just to help test out this case. It'll get you to a similar case that I was talking about earlier, where I ran into this initial problem with Boldin. So you can see it's we're gonna say, what if we retire at age 52? What if we have these account balances and we want to spend $72,000 a year? That should be $6,000 a month. So just some made up numbers here. One thing I just realized that I don't have here that needs to be put is if you have an existing Roth account balance. That would be very helpful. But for illustration purposes, this will work. So the way I have it right now is it's got a total gap. There's no Roth account helping you. There's no Roth conversion amount. We've got our married filing jointly status. This tool allows you to set just overall investment return rates so that anything you have invested over the time of this, of this ladder scenario or penalty scenario, early withdrawal scenario, actually has some gains. Inflation, you can set that. You can stress test this using inflation rates. Right now, I've got it set about 2.5, which seems to be, about where it's been lately. Okay, so now that we've kind of got that figured out, you can see some information up here. It's showing that, when you're going to turn 59 and a half, the number of bridge years you have from when you're planning to retire up until age 59 and a half. It says ladder kicks in, but there is no ladder right now. It does calculate the total amount you're paying in taxes right now and when your taxable account would be depleted, in this case 57. It's showing your total penalty, showing that your ladder status fails. You don't have a ladder yet, so probably should make that null if you don't have a ladder. But let's take a look. So again, there's a lot going on here. We'll go through it. This is a chart that's going to show the year and age starting when you say you want to retire, and it's going to go up until at least showing when you're 59 and a half. In this case, it's going to go, looks like, for about 10 years. It's going to show how much you spend every year. That amount you spend is going to grow by, it's going to have a cost of living increase based on the inflation rate that you put down here. So this is going to show your total spend no matter what the source is. This is going to show the total amount that's coming out of your taxable, your after-tax accounts. Anything you take out of pre-tax would be over here. And your total taxable account balance shows it decrementing every year here. You got the same with your pre-tax, either growing or decrementing based on whether you're taking money out. So in this case, we can see, sure enough, our after-tax, our taxable accounts, the ones we've already paid tax on that are basically free and clear, except for maybe some capital gains right now, run out. And when you're 57, you've got a gap. So in this case, you've got a gap of 59,478. That's the difference between what you need to spend minus what you had left in taxable uh, in your taxable account. Then you've got the next year you've got a gap of the full amount, and then here you're going to turn 59 and a half, and everything should be good at that point. And you've accumulated 28,359 in tax and 14,298 in penalties. So now, okay, can we do better than this? Rather than just taking that penalty to basically buy our way out of working, is there a better way to do this? Well, let's do this. Let's look at what happens if we put just our initial spend as a Roth conversion amount. And you can see this is going to make some changes. So now it's going to start converting money from your pre-tax account to your Roth account, and that amount every year. It's going to figure out how much tax that's going to be, and then that's got to sit for 5 years before you can start using it. So you'll see here that you start taking 72,000 there and 72,000 here, and now your gap goes down. You still got a gap; it's still failing technically, but your gap is decreased now, where it's like a partial gap, and you can see you're now paying taxes on the Roth conversion out of your taxable money. You're also paying, whenever you have a gap, the tax on your pre-tax, and you see your total penalty. Total penalty is way down now. I'm looking at that penalty and saying, maybe that's not so bad. Would it be worth buying your freedom for $2,173? That's a conversation worth having. You can see these 2 years where your ladder's active. Let's try something else here. And one thing I am trying to figure out, I think it's because it's not doing a conversion in the 5th year because you run out, because you've only got, I'll say only, it's a lot. You've only got $350,000 to work with. Let's do this. So we know that our spend goes up because of the cost of living adjustments. Let's get it closer to what we'll actually be spending when it comes out. Knowing that it'll grow a little bit, but let's raise it up. Let's try doing 82,000 and see what happens there. Okay, we're still getting 4 years of conversions. Our penalty went down. Our tax isn't up too much. Let me see what the difference was again. Let's compare. 72,000, we're paying 19,356 in tax. 2,000 penalties, so 21, close to 21.5 total. Let's go back to 82,000. Yeah, we're saving maybe about $1,500 or so there by doing a Roth conversion ladder. Now, one thing I'm kind of ignoring here is we are paying taxes out of our taxable on the Roth conversions, but I'm not really holding that against us as bad, because what that's really buying you, when you get through these bridge years, you've bought yourself a Roth balance that's going to grow tax free. So that tax money really got you something. So I don't really consider that a bad thing. But you can kind of see it's subtle. Like I said, there's a lot of nuance in there, but a Roth conversion ladder can help you. Let's go up to 90,000 and see what happens. Yeah, didn't really buy us anything, I don't think. Yeah, I mean, we're still going to run into 59 and a half once we get here. And once you get to where you can get your pre-tax, you probably want to not spend from your Roth. That makes more sense later down the road. You want to you're going to run into required minimum distribution issues if your pre-tax balance is too high once you get like into your mid 70s. So you want to spend that before you spend the Roth. Anyway, I hope this helps. Let me put this back. You can mess around. You could lower, if you lower inflation, it definitely helps. I sure hope that happens, but you can raise your investment return rate, and man, even if it goes up to 7%, then all of a sudden the latter succeeds. It goes to show what market returns can do. Let's see what happens if we put inflation rate back. Yeah, now it fails again, but not too bad. We're still below $20,000 from tax and penalty. But what I see here is I start to see something where, I mean, wow. If you get close and you just have to eat a little bit of penalty on pre-tax withdrawals, that's tempting. That's very tempting. But I hope this helps. I'm going to put this tool out. It's not, I'm running this locally right now. It's not on the DIY Retirement Tools site for you to use. It should be out there soon. I want to test it. I want to make sure it's in good shape before I turn it over to everyone to use. Well, that's it for this episode. Hope this was helpful. The tool's great. The Boldin retirement tool, other retirement planning tools are great, but you've got to look into the details and question certain things. Maybe have a professional financial planner, certified financial planner, look at it, or really dig into it yourself to make sure you understand and that it all works. In this case, the plan, may work. There's some hidden penalty fees definitely in there, and definitely some things you can do to make it a little more beneficial. First, want to thank all of my new subscribers. Really, just getting this started, and several of you have watched and subscribed, and it means a ton to me. I really enjoy doing this. This is something I spend a lot of time on because I enjoy. But if people get benefit out of it and enjoy it, then all the better. I look forward to doing some more. If you stuck around this long and you haven't already, like and subscribe, and check out DIYretirementtools.com. There's a link in the description, and we'll see you next time.